Good afternoon and welcome to the Asian Midday Market Watch. Our guest today is Kelvin Wong, market strategist at CMC Markets. As always, Kelvin, great to have you on the show on this Thursday. Very
Yeah,
cold
but
Thursday.
it's a bit rainy here as well as Singapore, but unfortunately the markets is not raining, but it's the opposite. It's high volatility in the
High
market space right
volatility,
now.
and we're going to get some insights for you on that.
Sure.
But before that, Kelvin, we're going to start with a look at crypto markets. Bitcoin is now at 35,089.7. It's down 7.71%. Ethereum is at 2,396.18. It's down 9.68%. Now, if we look at regional stock markets, we start with the SGX, which is at 3,297.8. It's down very sharply, 2.8%. Now, if we look at other regional markets, and just let's take a look at that, we've got the KLSE, which is at 1,571.9. It's down, and just give me a second. It's down 0.91%. Shanghai is at 3,439.97. It's down 1.46%. The ASX 200 is at 7,260.3. It's down 2.86%. The Nikkei is at 25,905. It's down 2.04%. The Hang Seng is at 22,889. It's down 3.26%. And the Kospi is at 2,655.59. It's down 2.36%. So, Kelvin, it's a sea of red across the region. Tell us why.
Yeah, so definitely if you look at the situation right now, we start to see heightened geopolitical risk. In fact, this geopolitical risk has been leveling up in the last 2 weeks due to Russian and Ukraine tension. And what we could see is that about 2 hours ago, Russia has really made its move. That means Putin has really ordered troops into Ukraine territory. And even there are some reports saying that airstrikes are being conducted by Russian forces onto a Ukraine defensive installation. So what we could see is that it's officially we start to see a military invasion by Russia into Ukraine. So that actually sparked this ongoing risk of situation that we see in the ASEAN stock market at this moment in time. And what's interesting over here is that we got to actually take a step back and ask ourselves what will be the next reaction will be. Okay, and especially if you look at the scenario, is that how will the Fed react from this situation? Because you know that as we know, Fed itself holds a vital role in terms of liquidity, managing of liquidity, or I would say indirectly managing global liquidity that is actually flooding into the financial markets, which will actually have an impact on stock markets and the rest of other asset classes. So we got to ask ourselves over here is that because it's actually nobody gets right now, it's a binary event. How will it evolve from this situation here? Would there be what I call a retaliation from the US and the allies? That means they themselves attacking back into Russia territory from there. So that is a scenario that we got to watch out for. And one thing we will share at this moment in time is that because Ukraine at this point in time is not officially a NATO member yet, means NATO, they're not an official NATO member. That means NATO states itself in Europe, they are not obliged to actually send troops to actually defend Ukraine at this point in time. So right now it all boils down to US. What will US do next? Will it start to actually mobilize its military forces like what it did in Iraq War One and Iraq War Two, or will they start to impose more sanction into the Russia we call it interest or even Russia itself or Russia corporations? But all in all, in the short to mid term, we definitely will start to see a bit of a jittery for the financial markets. So very interesting. I want to share the chart of this SPX 500. Okay, why SPX 500? Is because you know that SPX is the global bellwether for global stock market, and stock market always has a leading element towards global growth or economic growth for a country. So what you could see is that what happened next in S&P in the next couple of weeks will start to fill into the global economy space, be it in Singapore or in Malaysia or even in the rest of the world. So what's interesting is the chart of the SPX. So this is a daily chart. So what you could see that from this is the last major rally from the pandemic low. All right. So what we could see over here is the bottom of the chart is the VIX. So every time the VIX hit a resistance level, which is the line I draw in red, it managed to shape a bullish reversal. on the 15th of June, on the 29th of October 2020, on the 27th of January 2021, and most recently the two occasions in November last year, 30th of November and 24th of January this year, this last push. And what we're seeing now, the VIX now is actually attempting to test this resistance again, which is, because this is based on yesterday's price itself. Okay, it's US session. So very likely, right, we will start to see a push up in VIX tonight, to go above this resistance level, which is 32, unless things changes in the situation between Ukraine and Russia, which I look at the circumstances right now, is seems to me it's a bit hard to reverse right now, or what Russia has really did to Ukraine at this juncture. But what's important over here is that market is always leading, and you could see that the SPX, right, yesterday it has a daily close below this critical support level, which is 4240. So this is a technical level, because due to time constraint, I can't share with how I define this level. So this level,
Sure.
4240, is actually a level, right, to actually hold not even the major uptrend of this SPX that has kickstarted in March 2020, which is the pandemic low. In fact, this 4240 is critical for the long-term structure, the long-term circular uptrend of the S&P that was started in 13 years ago, or close to 13 years ago, from March 2009. That at that point in time. So that was actually after the great financial crisis low. SPX actually and didn't have a correction of 30% to 40%. So right now, right, the S&P 500 has a daily close below 4240. So tomorrow will be Friday, so which is crucial for the market. So if it didn't have what I call a weekly close back up to 4240, potentially right now we are now starting to see a brink, or the onset to kickstart a potential major corrective move that could take us to 30 to 40% decline. So for the coming months ahead, for the rest of Q1 and Q2, we will start to see a bit of a very negative feedback loop in the SPX 500, and we start to just snowball to the rest of the world. And in fact, you look at Asia right now. So Asia has been outperforming the US stock market since at the start of this year, because due to the one, it could be a confluence factor, because due to Asia are being more defensive because of a higher dividend yield, and also valuation are cheaper definitely compared to US stocks. But all these factors has been negated at this moment, or has been choose to ignore by the marketplace. Why? Because of the ongoing geopolitical risk. And if we have a view that market sentiment is always has a leading front in terms of economic activities, if this US stock market going to decline, it could actually create a negative feedback loop in terms of global sentiment, and that could actually come to a realization that, hey, it will actually lead to really that corporation will start to cut back on their spending, consumer will start to actually cut back on their spending, and don't not forget over here is that we still have a Fed that is still on a hawkish stance. So all this could actually gel into a scenario where we start to see the risk of stagflation coming into play into the second half of this year. But markets always be a leading factor to watch, because they are actually indication of forward-looking element, like forward-looking expectation of earnings of corporation. So definitely, if we talk about in the medium term, the next support level for the SPX will be at 3720. So we're talking about if that will actually lead us to close to about 11% decline from there. So I would say that it's not really a good scenario at this juncture for risk asset, at least from a medium-term perspective, and that could actually also create a start of a potential longer-term bearish trend on the S&P, which means it translates to a bringing forward of a potential bear market for global stocks as well. So I think before we go, we still have a bit of time, Brian, right? Let me share one more chart for the audience.
Sure.
So this chart I want to share is since the okay, so it's what I do that I put various asset classes together. I want to highlight over here is we have Bitcoin and Ethereum as highlighted in blue, and this we call it a turquoise blue or whatever. And from a peak of November last year, 8th of November 2021, that high, you could see that Bitcoin and Ethereum, and this rate and this particular we call it line over here, this orange line over here is the MSCI All Country World Index, ACWI in short, the ETF.
Okay.
So it consists of the global stock market as per se, and 60% is weighted in the US stock market. So we realize that cryptocurrency and global equities is actually going down hand in hand. So it offers
Yeah,
no
so it's very correlated. You can really
yeah,
see a very strong
it's
correlation.
offer there's no required diversification benefit at all right? And most importantly, you look at fixed income instruments. So fixed income instrument, you look at the one that has the most risk free, which will be the 20-year US Treasury bond. So I'm using the ETF called TLT, also in
Right.
red. So you realize that the TLT, yeah, it'll be lagging. It managed to do a bit of outperformance in the later part of last year. But if you look at recently, it also been ticking downwards as well, together with global stock prices. So it seems to me that the risk haven, the safe haven asset as US Treasury bonds also doesn't offer benefit as well, diversification benefit, I would say. And how about US investment grade bond? There were investment grade bonds. So you're talking about bond that has higher credit rating. So for sure, it's also the same thing. It's also moving in line with the downside movement in global stocks. And definitely will be junk bond, high yield bond as well, because those are definitely will be hit as well, given that it has a lower credit standing. So all in all, what we could see over here is that there is a big risk that is actually causing this correlation between the fixed income prices and US, what is it, global equity market is the
Mhm.
rising US Treasury yield. So right now is that if the US Treasury continue to get okay, right now it's slightly it turned down slightly, but if it continues this uptrend, we could start to see diversification benefits, right, getting eliminated between fixed income and global equity. So, uh, so that being said, that if this trend continue to persist into the way called this into the second half of this year, or even into the second quarter of this year, then out to the second half, you start to see 60-40 portfolio, right, also get hit as well. That means treasury 60-40 portfolio, it means 60% in equity, 40% in bonds. So because
Yep.
bonds, they don't offer this kind of benefits right now because due to the rising US Treasury yield, and because interest rate has been very low for a period of time, the market value of bonds will definitely get hit. So the mark to market value will get hit as well, even though they still give us a bit of what I call constant dividend coupon payment. But when you mark to market value, this is where the situation comes. And what's interesting over here is that the one that is offered a bit of diversification benefit will be gold. So gold has been on the tear right now. So what we could see is that gold, in fact, technically, right, has already broke out from a bullish formation, and it could actually from here going to push up upward given the strength in momentum. So gold is being supported by two things. Number one, initially we start to see inflation, which is a scenario where that is could benefit gold itself. But however, right now, on top of that, we start to see rising geopolitical tension that actually supporting gold as well. So unless geopolitical tension start to ease at this point in time, I do believe that gold momentum could actually persist for now, at least in the short to medium term. So definitely, then we talk about oil. So oil itself is actually uh, there's demand factor and supply factor. So right, it all depends on OPEC. How do OPEC wants to actually control the supply of oil going forward? So we got to watch oil right now. So they may start to feel a bit of pressure from oil consumption countries like US, Europe, or even
Yes,
Japan.
because we've reached the $100 mark already.
Yes,
So there
precisely.
will be
So
pressure.
so that's why so Saudis, especially Saudis and the OPEC plus members, do they want to come in and say that, hey, do I want to do a social good to the to the country as a whole? And most importantly, can they actually do they have the capacity to actually pump up more oil at this juncture in time? So that's going to be watched pretty closely in the next OPEC meeting going forward next month.
Now, Kelvin, thank you very much for your analysis and your insights.
My pleasure, Brian.
Now, we've been speaking to Kelvin Wong, market strategist at CMC Markets on Biztech's Asian Midday Market Watch. I'm Brian Fernandez. This video and podcast will be on our website, www.biztech.asia, as well as our various social media platforms. Please visit our website for great content on business and technology conversations ranging from market and investor news, leadership, wealth management, and technology. Thank you very much for tuning in.
Thank you, Brian.